My next guest says another problem is tariffs and uncertainty about the business cycle, which could force them to pause rate cuts. Joining me now is Michael Darda, chief economist and macro strategist at Roth Capital Partners, along with CNBC senior economics reporter Steve Liesman as well. Welcome to both of you. Mike, let's just dive in here. I want to talk PPI, but I really want to talk Smoot-Hawley. Maybe you tell me which one you think is more pertinent.
Well, I mean, given the way that you started the segment with the clip from Ferris Bueller's Day Off, you might as well just dive right into Smoot-Hawley, since it does look like Congress, or potentially the executive branch, is gearing up for the most significant rise in U.S. tariffs in about 100 years. And so if you go back to that period, the Smoot-Hawley tariff bill passed Congress in the spring of 1929 with a similar equity market valuation backdrop. So we've been writing recently about the so-called Buffett rule, the ratio of U.S. stock prices or market capitalization to nominal GDP. We're now at levels that haven't been seen since 1929. So it's certainly worth talking about that tariff shock in the context of high valuations and, some potential difficulties ahead.
But if I could summarize kind of what you're saying, it's what Ben Bernanke said about Milton Friedman, if I'm not mistaken, which was, we learned our lesson, we caused it. And in other words, the Great Depression was a Federal Reserve problem and not so much a tariff problem.
Exactly. The Smoot-Hawley tariff, I think most scholars agree, and Steve Liesman probably agrees as well, was highly disruptive, came at exactly the wrong time, but was not responsible for the Great Depression. The Federal Reserve presided over a collapse in the broad money stock by about a third and a nearly 50% collapse in nominal GDP. That does not happen without serious, systematic, and repeated monetary failures and policy mistakes. And so, the tariff gets a lot of the blame for the Depression, but it was really just more of a timing thing. That doesn't mean it was a good policy. But
no, of course. But what's interesting, if I may, is that, Steve, both of these things are the opposite this time around. So instead of being contractionary, the Fed might be too expansionary at this moment. And the Smoot-Hawley tariffs, according to Pettis, have a much more diminutive effect on the economy when you're running a trade surplus, as we were back then, not so much when you're running a trade deficit as we are now. In other words, that they could still rebalance us towards more investment, kind of help increase savings in a good way, which would not mean they're good for the consumer. They're bad for the consumer. But the context is very different now than it was 100 years ago.
So I kind of disagree a little bit with the gist of the conversation. First, I hope Mike is dead wrong that we have to learn this history lesson again. I don't want to be involved in replaying almost any part of 1929. And I think the other thing is the point you just made. The idea that the tariffs did not cause the Great Depression is not a reason to do them. I think it may well be said that it limited the flexibility of the U.S. economy to respond to the Depression and other issues mistakes that might have been made by the Federal Reserve. I think that's important. The third thing that I think is really important, which Michael brought up in his piece that he sent around, which is this. The supporters of the tariffs have tried to have it both ways. They've tried to say it's a punitive issue that we would use in negotiations. On the other hand, it's a major source of revenue for the U.S. economy and for the reconciliation process that would pay for the Trump tax cuts. Well, I don't know, but it struck me that the Republicans have for a very long time said that anything that would be a huge tax increase on the American public would indeed be negative for the U.S. economy. So I get that tariffs may not have been the worst part of the Great Depression. I get that they may not be so bad right now as they might otherwise been if we have a surplus. But I'm not going to engage in a conversation that says they're otherwise good.
Mike, as you kind of pull that into maybe a final thought here, the real question is also what this is going to mean for the Fed. Do you think they have to stop cutting rates here or no?
Yeah, I mean, I think that what we're talking about here is potential shocks to the supply side of the economy. And so we've been in a situation here where productivity has picked up pace. That's really a very positive story. It's helped the Fed in terms of bringing inflation down. So a combination of their previous monetary tightening, slower nominal demand growth, and stronger productivity has really been a very positive story, and risk markets have celebrated that. So if we move into an environment where we have potential supply side headwinds, whether they're tariffs or much slower growth in the working age population, that's going to make the Fed's job more difficult. And, it's easy to say what they should do, maybe from a theoretical model, but, we really don't know exactly what the course of policy is going to be. There's a lot of, verbal proposals out there, but eventually Congress is going to have to get going in terms of legislation. So we don't even really know how to handicap this. We just know that it's probably going to be a hodgepodge of negative and maybe some positive supply side forces, and the Fed is going to have to try to grapple with that.
Yeah.
So on the question of whether they should stop easing policy, I actually think they're probably pretty close to a pause here. And the reason I say that is what Fed Chair Powell was saying when the Fed went into the first rate cut and they delivered a 50 basis point rate cut right out of the gate was simply that they didn't know where neutral was, but they were pretty confident they were above neutral based on all the mainstream models. And now that they've lowered rates by 75 basis points, they're expected to do another 25 in December. They're kind of in the middle of the range in terms of mainstream estimates for so-called R-star. And their goal is not to go accommodative. It's simply to not be presiding over a restrictive monetary stance, given the progress made on inflation.
Yeah.
So a combination of macro data surprising to the upside over the last month and a half. You mentioned the hot core inflation readings and the fact that the Fed's already done 75 basis points, I think adds up to much less certainty in terms of future rate cuts from here.